Get ready for a truly transformative shift in how we think about money and finance. We're stepping into a world where traditional banking limitations might just become a thing of the past. Imagine a system where you can send money to anyone, anywhere, at any time, quickly and securely, without needing a bank in the middle. That's the promise cryptocurrency offers. It's not just a new type of money, it's fundamentally changing finance forever. So, what exactly is cryptocurrency? At its core, it's a type of digital money. But here's the key difference: it's not issued or controlled by any single government or central bank. Instead, it operates on something called blockchain technology. Think of blockchain as a shared, public record of every transaction, distributed across many computers. This makes the system decentralized, transparent, and incredibly difficult to tamper with. Every transaction and the currency itself are protected by advanced cryptography, which is essentially secure coding. This whole system runs on a public network, meaning there are no traditional middlemen like banks involved in verifying transactions. Cryptocurrency isn't just a niche tech trend anymore, it's gone mainstream. By 2025, there are over 420 million users worldwide, and that number is growing fast. Major companies like PayPal and Visa, are increasingly integrating crypto into their services. Even entire countries, like El Salvador, have adopted Bitcoin as legal tender. For you, this means potential for true individual financial ownership, giving you direct control over your assets. It offers unprecedented freedom for fast, global transactions, bypassing traditional banking hurdles. Beyond money, crypto is driving innovation across finance, gaming, art, digital identity, and the very structure of the internet. The roots of cryptocurrency are deeply tied to the distrust that emerged from the 2008 global financial crisis. People questioned the stability and control of traditional financial systems. In this climate, an anonymous person or group known as Satoshi Nakamoto published a white paper in late 2008. This paper outlined the concept for Bitcoin, the first cryptocurrency. Satoshi's vision was to create a peer-to-peer electronic cash system that didn't rely on intermediaries. The network went live shortly after, and the very first block of Bitcoin, known as the Genesis block, was mined in January 2009. The backbone of most cryptocurrencies is blockchain technology. It's a shared digital ledger where transactions are recorded in blocks that are cryptographically linked together in a chain. This ledger is distributed across a decentralized network of computers, often called nodes or validators. Because the ledger is shared and verified by many participants, it creates a trustless system. You don't need to trust a single entity like a bank. You trust the code and the network consensus. To access and manage your cryptocurrency, you use digital wallets and keys. Your wallet is like a digital vault holding your crypto addresses. Crucially, it contains your private key, which is the secret code that gives you access to spend your funds. There are different types of wallets, like hot wallets connected to the internet and cold wallets stored offline. Protecting your private key is paramount. Losing it means losing access to your crypto forever. While Bitcoin was the first, the crypto world is now home to thousands of different digital currencies. Bitcoin, or BTC, remains the most famous and often acts as the entry point for many. It's often referred to as digital gold, due to its limited supply of 21 million coins, making it function primarily as a store of value. Ethereum, or ETH, is the second largest and fundamentally different. It's not just a currency but a platform that enables smart contracts. These are self-executing contracts with the terms directly written into code. Ethereum is the foundation for decentralized applications, or dApps, and is central to the concept of Web3. Beyond Bitcoin and Ethereum, many other popular cryptocurrencies serve different purposes. Solana is known for its high speed and low transaction costs. XRP focuses on fast, low-cost international payments. Cardano emphasizes security and sustainability through peer-reviewed research. Polkadot aims to connect different blockchains, enabling interoperability. Avalanche focuses on scalability and speed for decentralized applications. And then there's Dogecoin, which started as a meme but gained popularity for tipping and community. A crucial category for beginners is stablecoins. These cryptocurrencies are designed to minimize volatility by pegging their value to a real-world asset, most commonly the US dollar. Examples include USDT, USDC, and DAI. They are useful for trading or holding value without the wild price swings of other crypto assets, but it's important to be aware of the specific risks associated with how each stablecoin maintains its peg. Let's look at the transaction process. When you send crypto, you specify the recipient's public address, the amount, and often a small transaction fee. This transaction is then broadcast to the network. Nodes on the network verify the transaction based on the network's rules. Once verified, it's added to a new block on the blockchain. This process is typically much faster than traditional banking transfers, especially internationally, and the record is publicly available on the ledger. The security of cryptocurrency networks is incredibly robust, built on several layers. As mentioned, the public ledger makes all transactions transparent and auditable by anyone. Cryptography ensures that transactions are secure and that only the owner of a private key can access funds. Crucially, consensus mechanisms are used by the network to agree on the validity of transactions and the order of blocks. The two most common are proof of work, used by Bitcoin, which requires computational power, and proof of stake, used by Ethereum and many others, which relies on participants staking their crypto. This decentralization across many computers makes it virtually impossible for any single entity to alter the ledger. Ready to get started? The first step to buying crypto is usually choosing a reputable exchange. Popular options include Coinbase, Kraken, Binance, and many others, depending on your location. You'll need to create an account, which typically involves identity verification following Know Your Customer (KYC) regulations. Once your account is set up, you can deposit money using methods like bank transfers or debit cards. Then, you can place an order to buy the cryptocurrency you want. After buying, you need to think about storing crypto safely. Leaving large amounts of crypto on an exchange is convenient but carries risk, as exchanges can be targets for hackers. A safer option for larger holdings is to transfer your crypto to a wallet where you control the private keys. Hot wallets are software wallets connected to the internet, like MetaMask or Trust Wallet, good for smaller amounts or frequent use. Cold wallets, like hardware wallets from Ledger or Trezor, store your private keys offline and are considered the most secure for significant investments. The crypto market, while exciting, comes with risks. It's vital to be vigilant about avoiding scams. Never, ever share your private key or seed phrase with anyone. These are the keys to your money. Always double-check website URLs to avoid phishing sites. Be wary of unsolicited messages, fake giveaways, or anyone asking for crypto upfront. Only use trusted, established platforms. Understanding the factors driving prices is also important. Like any market, prices are influenced by supply and demand. Hype cycles around new projects or news can cause rapid price swings. Large holders, sometimes called whales, can move the market with big trades. Bitcoin dominance, its market cap relative to others, can also signal market trends. Macro events, like inflation rates or regulatory news, significantly impact prices. Perhaps the most talked about aspect is volatility. Crypto prices can go up or down dramatically in short periods. This presents both risk and potential reward. Reasons for this volatility include the market's relative youth, lower liquidity compared to traditional markets, and the fact that it trades 24/7 globally. For beginners, it's often recommended to focus on a long-term view rather than trying to time the market. The legal status of cryptocurrency varies significantly around the world. In the UK, for example, crypto is legal but largely unregulated, though activities involving it are subject to tax. The US has a complex and evolving regulatory landscape. The EU is working towards comprehensive regulation with MiCA, markets in crypto assets. China has taken a restrictive stance, while El Salvador made Bitcoin legal tender. Always check the regulations in your specific region. Beyond speculation, crypto has numerous real-world uses. Remittances, sending money across borders, are faster and cheaper using crypto than traditional services. It's integrated into gaming, enabling true ownership of in-game assets. Decentralized finance, or DeFi, offers lending, borrowing, and trading services without banks. NFTs, non-fungible tokens, are revolutionizing digital ownership for art, music, and collectibles. Tokenized real-world assets could represent ownership of anything from real estate to stocks on the blockchain. DAOs, decentralized autonomous organizations, are new ways to organize and govern communities online. Crypto is a cornerstone of the emerging Web3. This vision for a decentralized internet aims to give users ownership of the data and digital assets, moving away from centralized platforms. Web3 applications often run on blockchain technology and utilize crypto wallets for identity and transactions. Ultimately, blockchain changes the fundamental concept of trust. Instead of trusting a central authority like a bank or government, you are trusting the code, the cryptography, and the consensus of the decentralized network. This has the potential to reinvent countless industries by removing intermediaries and increasing transparency. Many people are interested in how to make money with crypto, and there are several methods. Trading involves buying and selling crypto on exchanges to profit from price movements. Staking allows you to earn rewards by holding certain cryptocurrencies and participating in the network's consensus. Yield farming involves lending or staking crypto in DeFi protocols to earn interest or fees. NFTs can be bought, sold, or created, with value often tied to the uniqueness or artistic merit. Airdrops are free distributions of new tokens to existing crypto holders, often used for marketing. Play to earn gaming rewards players with crypto or NFTs for achieving in-game goals. As a beginner, it's easy to make mistakes. Common beginner mistakes to avoid include FOMO, fear of missing out, leading to impulsive buys, panic selling during dips, overtrading based on short-term volatility, leaving large amounts on exchanges, falling for scams, sending crypto on the wrong network, ignoring potential tax obligations, and investing more than you can afford to lose. So, how to start safely? First, commit to learning the basics thoroughly. Choose a safe, reputable exchange for your first purchase. Start with a small amount you are comfortable losing. For better security, transfer your crypto to a wallet you control once you understand how. Explore dApps and the broader ecosystem gradually. Stay updated on news and security best practices. Most importantly, keep learning. The space evolves rapidly. Looking ahead, the future of crypto in 2025 and beyond is incredibly promising. We'll likely see increased RWA tokenization, bringing real-world assets onto the blockchain. AI integration with blockchain is another exciting area. DePIN, decentralized physical infrastructure networks, are using crypto to build real-world networks. We anticipate more regulation clarity in many regions, which could pave the way for mass adoption by institutions and individuals. We may also see the rise of central bank digital currencies, CBDCs, which are digital forms of national currencies, though distinct from decentralized crypto. In conclusion, cryptocurrency is far beyond just money. It's part of a broader movement towards greater financial freedom, access, and ownership. For many, it's seen as a potential hedge against inflation and a way to participate in a new digital economy. It fosters community and drives incredible innovation. For beginners, the world of crypto rewards curiosity and persistence. Learning is absolutely key to navigating this space safely and successfully. The possibilities are truly endless.